Although we always say like balance sheet and cash flow are twin brothers and sisters, but balance sheet is a statement, and all the numbers are based on a certain date as of that date. Whereas cash flow and profit and loss are measurement of the performance of the company within a certain period of time. Because you have to understand these two differences very well. And when you go to study work on financial ratios, there are a lot of times like, oh, asset turnover. Say for example, if you use just one end of the year asset and compare the full year revenue, it could be a mismatch. So what you have to do is use the average asset, which is the average of the current year and the previous year assets, and over the revenue. Then will be more like peer-to-peer comparison. And then Hong Kong is a very interesting place because the currency is packed with US dollars, as you know. But then most of the companies listed in Hong Kong, most of their earnings are coming from China, and there are currency issues. Okay, there will be the trading currency is Hong Kong dollars, and the P&L balance sheet everything is in RMB. That leading to the question whether RMB will change as time goes by. And then leading to the question is whether you're using RMB on a quarterly basis, end of the quarter or end of the year. And what about the future? It's nothing wrong for you to project only, say, assuming the RMB will be constant at a certain price with US dollars or Hong Kong dollars. For sure, in the long term, you can make the assumptions, make your life easier. But if you want to project or use some other third-party projections, it's all fine as well. That leading to changes of your financial model. I mean, the valuation. And needless to say, like sometimes when the company present EPS, DPS, they can present in RMB and also can present US dollars or Hong Kong dollars. That also makes you a little bit confused. And the base rate that they're using could be different from yours as well. Okay. This is an example to show the relationship among the three statements. So we have the net income, the income statement of the net income attributed to non-controlling interest will be the blue line, sorry, the red line, going to the balance sheet like this. And also we have the net income going to the retained earnings here as well. So these are the linkage between two. And on this side, you can see the cash, the ending cash of the asset will go to the ending cash of the cash flow statement. So you make sure the cash can need to be tied with each other. I'll give you a little more details, but this is only a quick overview of the three statements. So when you work on financial modeling, this kind of industry norm will suggest you to work on at least 3-year historical numbers. Okay, we can show you a website which helps you to extract the financial numbers quite accurate and quite fast, and suggest to have at least X quarters in the P&L. But say, oh, we don't have time to finish all the quarterly. Fine. I mean, you can just work on annual. It's fine. But remember, you will come across their third quarter results very soon, right? And if you project the 2023 numbers, in fact, the first 3 quarters already reported. That means you're pretty much projecting fourth quarter. By all means, you're working on quarterly. Okay, then it's important to forecast your all the key operating metrics. You can identify 3 or 5 or more of the operating metrics. You have to use the previous year to project the future, previous quarter to project the future, and also compare the industry standard with your company as well. And there are other issues as well, then but I just better to skip it. And it is nothing wrong to build your scenario analysis starting from the operating matrix, and which normally are quite sensitive as well. So this is a basic approach for you to build the forecast. So normally you have 4 quarters. It's a tester model, but again, the sort of formatting is not great um, because of change of the computer. Sorry. You normally use 4 quarters number and submit it submit sum together become the full year number. Okay, so that's very easy. So if those quarter numbers already are historical number, you just use to focus 1 quarter and then add 3 quarters of historical, that become a full year number. Okay, and this is more like a industry or experience sharing. Um, a financial statement can easily consist of like 50 or 100 items across 3 statements. No need to spend time equally on every numbers. 80-20 rules or even 90-10 rules. Okay, focus on those financial statements, financial modeling items, which are key driver of a story. Remember when you leave the hall like 2 weeks ago, and I talked to some of you, and I keep emphasize before you're leaving now, you have to think about how you pitch your story well. And those pitches will be leading to your focus on your analysis and also your financial model, like in terms of number of lines. Okay. So once you know your focus, you should spend more time to do research, should discuss more, and make sure your model should reflect on what you discuss. Okay. Um, and sometimes some P&L and cash flow items, if it's not important, you can assume zero. And the balance sheet, you can also assuming the current year could be same as previous year. Then save your time. Then spend more time on the rest of those which are very important. And obviously, when you review, you need to review a financial model and make sure balance sheet should be balanced. Cash flow in balance sheets will be same as the cash flow in the cash flow statement. Um, Normally, cash have to be positive. Sometimes when you have a mistake in your model, cash I've seen not numerous times, cash become negative. Bankruptcy, no errors like this example, no circular reference, and tell you how to do it. Um, and you just randomly check 8 or ask another members to check the formula, at least 8 or more to make sure there's no mistake. Okay. And because it's a Hong Kong listed companies, and I want to touch base on that. Hong Kong listed company normally they disclose based on interim and annual. Fortunately or unfortunately, this is a dual listed, also listed in US. That means they are required to disclose on a quarterly basis. Okay, then you avoid this kind of problem. But for those company which voluntarily disclose quarter numbers, they normally will disclose a 3 months, 6 months, 9 months, full year. Then you have to subtract the second quarter from 6 months, subtract by 3 months. Okay, so these are a little bit complicated then. And because you will face the first quarter, the third quarter result, and normally result will be disclosed in an announcement. An announcement, in some cases, we will firstly publish on Hong Kong Stock Exchange website, and then followed by the company on IR website. But like if this company have a good practice, then they may disclose on both sides at the same time. So next page. So back to P and how to do forecast. And normally some companies like just like I show you, Tesla has 6 different revenue line. I would strongly suggest you work on mostly four at most. If you want to simplify, you can group, you can just work on one, the major one, and group the rest into others. That's fine. Okay. Others doesn't mean it's not growing, it's still growing, but not paying too much attention on it. But all depending on your team. We'll prefer to focus on year-on-year basis rather than quarter-on-quarter basis. Okay, for most of the items, unless we talk about it. Oh, there's a there's one question from Monica. Okay, sorry. If we use a quarter forecast, is it need to a fourth year's quarter? Um, yeah, why not? Because that's the reason why a lot of analysts just extrapolate and growth rate will all the way same every year. I mean, building the model framework is once you build the framework and once you link the first year correct, first quarter correct, you just extrapolate. Normally it will be all correct. So, but then the most complicated part will be remember how we suggest you to do is have a team discussion on some major topics and come up with the conclusions like margin trend, growth rate trend, okay? The market growth going forward, all these kind of things, and then the colleague will work based on those guidelines, okay? Even though it's quarterly or annual. So seasonal effect during COVID and after COVID, yeah, I mean, I would say, yeah, that's all relevant questions, but uh, I would say it is important to know the seasonality, but then when you work on 2023 numbers, you also need to benchmark against 2019 and 2020, rather than just purely use 2020 as a growth drivers. Obviously, if you want, you can directly link the model from 23 to 2019 directly. But the challenge is they may have changed some of the presentation approaches. You know, they may add new revenue line or no, I don't know. You guys come back to me. So I would suggest your model will be easier to refer to back to or link back to from 2023 to link back to 2022, but then use another table to justify your revenue level vis-a-vis 2019 revenue level and show, oh, now my forecast is like 90% or even 120%. Okay. Rather than directly using 2019 numbers directly linked to that will be a little bit challenging in my view. But ultimately it's your call. So gross profit is very likely to be a key variable, but unfortunately, if I can recall my memory well, they don't provide you gross profit. Then back to maybe operating profit is important. And no matter what, remember, many companies nowadays they have incurred share-based compensation expenses into the forecast and talk about it later on. This is a non-cash item and could deviate a lot when the share price keep changing. Okay, so strongly suggest you forecast your costs based on non-GAAP approach, which is it's normally excluding share-based compensation expenses, and could be some other item defined by the firm as well. So interest income, okay, then back to the interesting point. I just tell you, oh, don't use Q on Q as a forecast, but in fact, this is one of the exceptions. Sorry, because if you use the average cash item and uh, link to your interest rates, then you can create a circular reference. Okay. And normally, if you use Q on Q, year on year as a forecast, that could lead into some unnecessary challenge because if the company cash is accumulating, So this quarter they have $100 cash. Next quarter 110. So the interest income within that quarter will be quite similar. But last year they only have $50. So if you want to use Y and Y, could be a big jump. Then normally it would be easier to use Q on Q rather than Y and Y. And don't will advise not to use the average cash because that will lead into circuit reference. And once you have circuit reference in your model, which is easy to find because Excel at the bottom will show it, and then your model will be stuck. That means it's not running. And wherever you change the numbers, oh, I finished my model, but numbers didn't change because it's stuck. Okay, it's a mistake or it's an error. So you have to fix it. So this is one way to avoid the circuit reference. Okay, and interest rates and tax will be better to forecast based on non-GAAP. If your company have enjoyed tax holiday, you should think about in the going forward, will the tax holiday be expired or not? You can assume it will expire. You can assume it will go all the way along forever. And then back to the margin, it's as I say, this is normally a quite important variable, but because in many cases, management are easier to maintain the revenue line, but margin is somewhat difficult to control, like labor costs, okay, competition, raw material costs, and normally margin compression are quite common when the company getting into more mature phase. Obviously, if they have new business model, in fact, the margin profile could be different as well. Okay, um, that's a way to think about the operating leverage. But like the whole world can't be perfect, right? You have a very low-hanging fruit type of business model. They be, oh, I can just partner with some partners and can launch whatever number of hotels anytime I want, which is good. You can easily reach the market fast. But can you control the quality well? Can you respond to competition better? Depends. I don't know. That's a very funny way of thinking. Revenue line with large revenue but low growth rate and lower margin versus the smaller revenue line but high growth rate and higher margin. What I want to say is when you come across a company with existing business which actually doing well but it's getting to more mature stage, but you have a emerging business and now it's not even 10%, but maybe 3 years. One of the team members think, bang on the table, bam, it will be 50%. That will be a dramatic change of the profile. And we've seen so many cases like this. Okay. Like in old days, Apple, right? With iPhone, wow, change the picture because old days is only a Mac, right? So you have to think about whether you can identify some emergent uh, like business, which actually may change the profile of the company very well. So obviously, you need to consider whether the company have any cost cutting measures and need to cut benchmark the cost against peers, like in terms of margin, say, for example. These are the key considerations. And also margin could include impairment charge, disposal of assets, any new business development, as I mentioned. And the key question will be, do you have long-term margin normalization process? That means no matter big or small company, the long-term the margin could be stable at certain level for then this is a more art science. So P&L done, and then we need to touch base a little more on balance sheet. We'll talk mainly on balance sheet because cash flow are just a twin sister of balance sheet. If you don't change balance sheet forever, cash flow will all be zero. For the next 10 years, okay, balance sheet will be unchanged. Your cash flow statement done because zero, everything. No way. So it's just a page because I wanted to show you a link. In the old days, I also taught some of the students how to balance sheet through their internship in my firm. So this is what a live example. You can click in the link to see how to balance sheet. Normally, if you get used to it, you can finish in 15 minutes. But you may have to keep doing it because even experienced analysts, after you change it like 20 items, 30 items of the model, likely to create error and likely the balance sheet will be unbalanced. Okay. And the first one, you can also easy to extract numbers from uh, a, a, a source, like table reading tools that can extract the numbers one by one. Okay. Then you don't need to type, extract and copy and paste back into your model. Much way faster, right? And more accurate. Most important is more accurate. Okay. So, okay, back to balance sheet and cash flow approach. Our aim to forecast balance sheet is to forecast the net cash in near and long term because it is a very important measurement of the financial healthiness of the firm and potentially how much can they give it back to shareholders. Am I correct? The purpose of cash flow forecast is to support the balance sheet, as I say, but we never forecast every single line of items in the cash flow statement because when that balance sheet item always keep unchanged, then the cash flow relevant cash flow items will be zero. So accuracy of balance sheet and cash flow statement are not important. No one will challenge you. Oh, your net cash is wrong. No one look at it. But the trend, direction, and the magnitude, the size of certain items are important. So this is a basic framework of a balance sheet approach. So normally you have the beginning balance, then add increase or decrease uh, of a certain amount, and then your specific items like add back and orders, and then your ending balance. So when you do forecast, make sure your forecast changes. That means the ending balance minus beginning balance will be linked to your cash flow statement. That means this part linked to cash flow statement, and then yeah. So wherever you build a balance sheet item, you need to make sure you can find a relevant cash flow items and link together. If not, your model will be imbalance. And just give you an example, in particular in the shareholders equity, because every company has shareholder equity, and normally it could be a bit complicated because besides net profit, you can have dividend, share buyback, and share-based company expenses as well. These other items are quite commonly should be included uh, in the balance sheet and forecast. Okay, and this give you example retaining earnings, non-controlling interest, and paying capital. How would you add on new items for forecasting? So this is more like a style of linkage among the three statements. So the upper right corner is a P&L. You have uh, income before tax, net income, and net income attributable to BYD shareholders, which is excluding the non-controlling interest. So like say this item, the non-controlling interest will link to balance sheet, non-controlling interest here, the balance sheet. And net income attributable to BYD will link to net income here. But like in this cash flow statement, because this is a Hong Kong listed company presentation, they normally present starting from profit before tax. That means the income before taxation will be linked to here. Yeah, a little bit complicated. Yep, right. So hopefully you get it. And the next one will be balance sheet for same. I mean, we just give you a little more example on, okay, if you have retained earnings plus 274 million and then minus 56 at non-controlling interest, your cash will be increased by 217. So that's what we think about. So as I say, that when there's a change in balance sheet, there will be corresponding change in cash flow statement. Accuracy are not never be important, and no negative value in balance sheet, except a very very rare case. 99% will be positive value. Okay. Um, you have to double check the model if you have negative value. So make sure all balance items are forecast. Even though some items you don't, you say, well, I say it's not important. You just link the future as of the latest year. That's all enough. That's good. Forever, same. It's already completely focused. So it's good to read the uh, balance sheet section in the accounting policy. Okay, and I identify 3 to 5 key balance sheet items. As I say. So I've mentioned many times about share-based compensation expenses. Just to give you a little color, what's that? This is an option expenses. Not sure how many of you heard from professors about that. So what you have to do is, okay, the company issue option to hire new talent or keep them in the firm. So SBC will be increased uh, if more employees option increased and share price increase as well. But this has not never been an easy item to forecast. So what I suggest you to do is just to assume this item will be the same forever. Okay, but you can base on the latest quarter number, and then assuming every quarter will be the same. Just remember this is non-cash item, but you still have to you need to have projection, but just projecting unchanged forever, and link back to your retained earnings. And then cash, somehow the definition of cash could be a bit more confusing because like this case, a Hong Kong listed company, the way to present cash could vary. So like in the balance sheet, they call it current deposit and cash equivalent and 6224. And then here they say it's total deposit and cash equivalent 6260. So this the definition definitely not the same. So what we have to do is to make sure you just use the balance sheet cash as a base case, and just assuming this will be the line variable line and link to your cash flow statements. Okay, so make sure that you can find the cash here and there, which could be linked together. And this is one of the approach how to tie between I mean to tie the difference between the balance sheet cash and cash flow cash. Okay, these are some of their approach, but this is not too complicated. You know, you can just say okay, others, and keep others always the same, every year the same, and sometimes you can find it in different companies. This is some of best practice to forecast fixed assets like property, plants, and normally it's a percentage of revenue. There's no way to say this is a stable number because it could go up and down. It's just assuming a certain number, which could be consistent enough. And depreciation is same. But normally I use this formula, probably begin plus capex divided 2, rather than ending fixed asset because sometimes when you build some new fixed asset, it doesn't mean you can amortize or depreciate immediately. Sometimes you capitalize. So we better to use only half of the capex. It's timing issues. Okay, so this gives you a little more details about property and intangible asset, especially like depreciation years normally disclosed in the Hong Kong financial statements. And this is an example of China Mobile. It's more complicated the way because they also provide you the disposal and asset write-off. You heard about it, but it's not that easy to handle it. You can just assume this item will be zero forever. Just give you a little bit overview of some of the case like Netflix. the key capex item are not building plants, not property, but building new content, movie, TV episode, right? So they capitalize it. Sometimes some movies can be filmed for 2 years, right? They capitalize it, but they will start to amortize it once it is launched on show. And then the amortization period will be 6 months to 5 years. And my based on my calculation is actually less than 2 years. And it should be a accelerated approach. That means will be more upfront loaded. So that means for sure, this only give an example, and I believe your target company likely to be a fixed line depreciation. Okay, but just read 1 or 2 lines of their accounting policy is good. And that's the best way to project working capital, because if you just fix the account receivable days, sometimes you can have uh, 1 year increase of your account receivable, and the other year will be decreasing. But as your revenue line has been increasing, it should keep the account receivable ending balance will be increased every year. So this is one of the just experience sharing. Okay. There's you can work on additional analysis of working capital as well. Don't try to repeat it. Okay, joint venture, this page will be skipped because I don't think that it's too important to you. Okay. Goodwill is something that will be incurred if the company have acquired a company. And normally, if there's no further acquisitions, and if the company valuation, the management didn't want to change it, goodwill value will be unchanged. If you find the goodwill value changed, that means they write down the valuation of the firm, of the previously acquired company. Okay, balance sheet. As I say, I give you a link. You just go to the link, watch a video around 15 minutes. You can understand. But if you still don't follow it, read through it, then I don't need to repeat it. Okay. Okay, this will be the final session. How to forecast dividend and share buyback. Why so important? Because this is what a shareholders want. Okay. Obviously, you can argue, I want to have capital appreciation, but a lot of investors want dividend. And now, also in nowadays, like American firms like Apple paid substantial amount, 70% of free cash flow in the form of share buyback. Okay, you have to understand that there's at least a few ways for the firms to pay back the shareholders. The first one I want to mention about is dividend. If you go back to your textbook, normally the textbook will say dividend payout ratio is dividend divided by earnings. But in industry terms, in fact, the payout ratio I'm referring to DPS over EPS. I think most of the listeners say, okay, is there any differences? Yes, because of the timing difference, and the share count will be different, and I'll tell you later. Like the case of MGM, for sure it's a little bit dated on this table, that they will announce the first half results, which first half means fiscal year end of June. Sorry, the first half end of June, not fiscal year, like interim end of June. But the announcement of the dividend date is August, but they pay in September, which is 3 months away. Imagine if a company keep buying back shares every month. The number of shares of the time of they report, well, the end of the reporting period will be different from the share count of the dates when they pay the dividend. Okay, if you keep repeating, that accumulated error in your model will be high. And in the case they will sometimes pay special dividends suddenly. There could be more and more deviation. So the timing difference between EPS and DPS are key reasons of the mismatch of the earnings and dividend paid. Okay, and you have to make sure you know the exact timing of the payments, and then you can calculate the exact timing the dividend will be paid. And together, in the case of Hong Kong listed company, as I say, earnings are in mostly in RMB, but dividend are in mostly in Hong Kong dollars. That means during that 3 months period, RMB can change as well. That means the DPS and EPS could be for sure. I would say most of the case when they announce dividend, they will ensure they pay in Hong Kong dollars already. But that's a currency risk that the firm need to incur, in particular those still listed in Asia and Hong Kong. Okay? As some of you know, there's some company still listed. Then the announcement of the Asia dividend could likely deviate from the Hong Kong dividend as RMB appreciate and depreciate. But nothing we can do because Asia shareholders can only get Asia. Same. Okay. But in your model, you have to understand that dividend, very likely 99%, will pay in the form of Hong Kong dollars. That means once they announce that Hong Kong dollars, that will be unchanged. Okay. But in the field, when you do projections, if you project RMB will appreciate, depreciate going forward, that will lead into the change of the dividend yield profile too. So this is the summary of formula. It's complicated, I know, but what I want to highlight is the dividend paid. If you pay in 4 quarters, so the first quarter pay in second quarter, and second quarter pay in third quarter, but the fourth quarter dividend will pay in next year first quarter. So if we rework on quarterly dividend model, the dividend pay in the cash flow will be different from the dividend that incur in that particular year P&L. So that's the way to think about it. And most of the analysts will get easily confused. So if you have joint venture, dividend profile will be even more complicated. Anyway, we skip it. Okay, this is a basic methodology. You just need to assume a certain payout ratio and consistent every quarter or every year. You may assume the payout ratio will be increased going forward as time goes by. 100% or even more than 100%. And I've experienced a lot of cases that some company at the beginning, in the first place, they pay lower payout ratio because they change from 0. How can you change from 0 to 100 immediately? And then change from 0 to 20, and then add on 40 and 60, something like that. Okay, this is common. So like this case, we project the dividend per share of common stock will be in RMB. And then the actual DPS will be in Hong Kong dollars. Then you have to add back a line to link the RMB forecast and then convert RMB dividend into Hong Kong dividend. Okay. So the final section will be share buyback, very easy. It is a very important actions for most of the American companies to pay back shareholders nowadays. Apple pay 4 times more free cash flow to buy back shares than dividend. Same as Microsoft. Okay, 3 times more. So you just look at Bloomberg, oh, this company have very little dividend pay. In fact, you didn't go deeply into the financial statement well. Okay, that's why during our previous workshop, we define a capital return formula. So this is Apple definition, better say, add back the share buyback amount with the dividend paid together. Okay, and this company happened now in Hong Kong and also in Asia, so it's not anything new. but just you have to pay attention on what's happening because after you buy back the shares, you subtract your cash flow through financial cash flow, and then the number of shares will be increased. But obviously, ending cash will be decreased. That means interest income may decrease too. Okay. The good thing will be EPS will be increased. Okay. So um, we just go directly into the forecast. This is a simple model of Apple. So you can see every quarter, you just have to look at how many shares do they repurchase, and then you can factor in the purchase price, and then repurchase consideration. And sometime because every year they could add new employees, there will be new share addition. Because in the case of I think both Hong Kong and US listed, they would disclose their repurchase number of shares quite promptly. So you can add back, oh, why there's difference between the ending number of shares and the repurchase shares? Because they may also have some new shares add, but I don't know why there's negative. Right? Maybe timing differences. But normally we will add positive number in here, new share dilution. That means every quarter we assume they will add back more new shares. And yeah, this will be factored into the share count. Yeah, that's it of today. So pretty good timing because we have 15 minutes for Q&A. You have any questions?